Datavault AI, ticker DVLT, is not currently trading. The U.S. markets are closed for the weekend. The stock's last active session, on Friday, November 14, 2025, was incredibly volatile, finishing the day at $1.83, a surge of 29 cents or 18.83%. Now, the immediate expectation when you see a sub-$2 stock explode by nearly 19% on massive volume is that it's a speculative, low-float gamble. The assumption is that this is just retail traders on their Robinhood app or SoFi Invest platform chasing a short-term headline, a classic pump-and-dump setup. But the reality of what is happening under the hood at Datavault AI is one of the most dramatic and high-stakes corporate stories on the market right now. This 18.83% jump isn't random noise. It's the market frantically trying to price in a reality that has completely disconnected from the stock's recent past performance. What we're witnessing is a potential inflection point, driven by news so significant it forces a total reevaluation of the company. And it's all coming to a head with their earnings call scheduled for this coming Monday, November 17th. The general belief, the narrative that has kept this stock in the sub-$5 range, is that it's a high-risk, cash-burning micro-cap AI company. And to be fair, that was and still is a significant part of the risk profile. When investors are building a stable portfolio, perhaps using Schwab Intelligent Portfolios or a Fidelity Wealth Management service, they are actively avoiding stocks like this. They are buying Fidelity ETFs or blue chips like Apple stock for stability. The self-investing crowd, however, the ones actively managing their individual brokerage accounts on platforms from Fidelity to Robinhood, are constantly hunting for the next Nvidia stock or Tesla stock before it becomes a mega cap. The expectation is to find that hidden gem. But here is the challenge to that thinking, and it's a profound one. Datavault AI is not just another AI-washed company. The data shows this 18% move is likely a pre-earnings run, an anticipation of what's coming on Monday. The company just issued a staggering 2025 revenue guidance of $30 to $50 million and projected 2026 revenues above $200 million. On top of that, they've announced a pending $150 million strategic investment from Scilex Holdings. So the reality isn't a small-cap stock hoping to make a few million. The reality is a company that is telling the market it's about to scale exponentially, backed by a massive 9-figure capital injection. Let's break down this recent trading action. That 18.83% spike on Friday wasn't on thin air. It happened on a day with nearly 50 million shares changing hands. This is not a quiet, overlooked stock anymore. This is a battlefield. You have active traders using the advanced tools on the Interactive Brokers trading platform trying to scalp volatility, while new investors are piling in through their Fidelity mobile app or SoFi active investing accounts, terrified of missing the next leg up. The volume tells you that institutions are now paying attention. This isn't just a retail phenomenon. When you see guidance for $200 million in revenue, professional funds are forced to at least run the numbers. This is a level of activity that completely separates it from a stable, long-term investment in Fidelity mutual funds. This is high-stakes online investment, and the platforms themselves are facilitating it. Whether it's SoFi stocks or Robinhood stock trading, the ease of access is pouring gasoline on this fire. But the sophistication of the platform matters. An investor using Interactive Brokers can see the order book and the Level 2 data, while someone else might just be hitting the buy button on Robinhood fractional shares. The 52-week range for this stock is 25 cents to $4.10. That tells you everything you need to know about the risk. A move like this is attracting traders, but it should be a massive red flag for anyone looking for simple investment help or a stable, intelligent portfolio. So, what does this company, which has caused so much commotion, actually do? This is the most important part of the story. The expectation is vague AI. The reality is a radical and specific corporate transformation. Datavault AI used to be known as WiSA Technologies, a company focused on wireless audio technology. That is the past. The company has pivoted hard into a pure-play AI and data monetization enterprise. specifically focusing on Web 3.0 and the tokenization of real-world assets, or RWAs. This isn't just a press release. They have tangible, high-value deals. They are an IBM Platinum partner using IBM's watsonx.ai platform. That's significant validation. But the core of the bull case rests on two recent massive deals. First, a $10 million exclusive license agreement with Scilex Holding to tokenize genomics and biotech data, a deal that includes potential milestone payments of up to $2.55 billion. Second, a deal with Nature's Miracle Holding to license its carbon credit tokenization system, which comes with a $2 million fee and a 35% royalty on all gross revenue. This isn't a company hoping to find a business model. It is locked-in partners in the white-hot biotech and sustainability sectors to build a business around valuing and trading data as an asset. This is what analysts are looking at when they float a consensus $7 price target. Now, we must balance this incredible story with the financial reality. This is where the tension is highest. The expectation is that a company with this story must be solid. The reality, if you look at the financials, is terrifying. As of September 30th, 2025, Datavault AI had only $1.68 million in cash on its balance sheet. In the first 9 months of 2025, it used $23.2 million in cash from its operating activities. You don't need to be a Wall Street analyst to do that math. The company was running on fumes. This is the massive risk that bears will point to. This financial precarity is likely why the stock was trading at 25 cents earlier this year. But this is what makes the other news so critical. The company has been surviving by issuing convertible notes and stock. But the game-changing catalyst, the one that makes or breaks this entire story, is the pending $150 million strategic investment from Scilex. If that deal closes, the $1.68 million cash balance becomes irrelevant. The entire going concern risk, which was a very real threat, is effectively solved. This $150 million provides the capital to fund operations, execute on these new contracts, and build the infrastructure to hit that $200 million revenue guidance. This 18.83% stock pop on Friday wasn't just about the revenue guidance. It was the market's realization that the company might have actually found the funding to survive and achieve it. This brings us to the future outlook, which is defined by this extreme binary tension. With the Q3 earnings call just 2 days away, we are at a tipping point. There are two very clear scenarios. In the bull scenario, management on Monday confirms the aggressive revenue guidance, provides a concrete update that the $150 million Scilex investment is on track to close, and perhaps even announces another partnership. If that happens, the $7 analyst targets start to look less like a fantasy and more like a roadmap. In this scenario, the $1.83 closing price will look like a historic bargain, and the online investing community that got in early will be celebrating. The SoFi trading platform and Fidelity trading platform will be flooded with buy orders. But the bear scenario is just as real and would be catastrophic. In this scenario, management walks back the guidance. Maybe they say the $200 million target was aspirational. Or even worse, they announce a delay or a problem with the $150 million Scilex investment. If that capital lifeline disappears, the company's $23 million cash burn rate and tiny bank account come roaring back into focus. The high revenue projection narrative would collapse, and the stock's $1.83 price would have no fundamental support. It would be a brutal awakening for everyone who bought in on the hype. This is why this isn't an investment for your Fidelity IRAs or a set-it-and-forget-it holding. It is a high-stakes bet on execution and financing. This is where I want to hear from you, as this story is unfolding in real time. With earnings coming on Monday and a $150 million investment pending, what are you doing? Comment below. Are you buying DVLT, or is this revenue guidance just a fantasy? To summarize this entire situation, we are looking at a perfect case study of expectation versus reality. The stock closed at $1.83, up 18.83%. The expectation is that this is just another volatile, speculative, microcap AI stock, the kind of name you gamble on with a small Robinhood position. The reality is that this is a company in the middle of a radical strategic pivot to RWA tokenization, backed by major partners like IBM and Scilex, and guided by management for an absolutely explosive ramp in revenue. The entire story hinges on a pending $150 million investment that would solve its dire cash burn problem and fund its ambitious growth. The 18% pop isn't the end of the story. It's the market just now waking up to the stakes. The gap between the $1.83 price and the $7 analyst target is the entire bull thesis, while the gap between its $1.68 million in cash and its $23 million operating burn